All right, everyone, welcome. We are pleased to welcome this fantastic panel. We do have Brien Lundin, Executive Editor of the Gold Newsletter. We also have Rick Rule, President and CEO of Sprott U.S. Holdings, Inc., Peter Schiff, Chief Economist and Global Strategist, Euro Pacific Capital, Inc., and Adrian Day, Chairman and CEO of Adrian Day Asset Management. Gentlemen, thank you so much for being here today. The floor is all yours.
Great. Thank you so much. Brien here. I'm going to, I guess, MC this closing panel, but we'll see who comes to the lead with most control over this. It will tend, I think, to get a little out of hand with this group of experts that we have here. Guys, we're bringing this show, I believe, the Money Metals and Mining virtual seminar to a close here. And I know this group, especially at the Money Show, tends to bring in investors of all stripes, a lot of people who may not be as familiar with this sector as we are. So what I'd like to do is kind of bring it all together. And we've heard a lot of sage advice during this conference. And I think people maybe have gotten overwhelmed. So let's kind of look at the big picture here. We only have 30 minutes, so I'd like everyone to try and keep their comments succinct and to the point. And I think I'll further handicap at least 2/3 of you by starting off with Adrian, who in his British accent will make the rest of us sound much dumber by comparison.
Nice.
So Adrian, let's start off with you. Let's put this bull market in context. You know, there have only been a few bull markets in the history of gold, although it's the oldest asset in the world, millennia long, as a freely traded commodity / money with markets made in its value in all currencies. It's really one of the newer assets out there. So it's only had a few bull markets in its entire history, depending on how you slice it. How does this one compare? Is this a big one? Is it a small one? Is it like anything we've seen before? And talk a bit about what's driving this one.
Yeah, you make an interesting point there, Brien, which is that gold is supposed to be a store of value. Over time, it is supposed to, and not just supposed to, but it does hold its purchasing power. So over the millennia, certainly over the centuries, over the millennia, you don't invest in gold because you think gold's going to go up. Gold is a store of value. Now, of course, what's happened since 1971, when Nixon took us off the gold window, is that the currency has been depreciated like heck. And because the currency, and I won't call it money, because the dollar is not money, it's a piece of paper. Because the currency is being depreciated, then gold is going up. But really, the story is the depreciation in the purchasing power of the dollar and other currencies around the world, rather than the appreciation in gold. What's driving it is what I just said. What's driving this bull market right now is the Federal Reserve's and other central banks' idiotic, crazy policies, and policies in air quotes, if you will. You know, we had inflation in the 70s, and we had the Federal Reserve at that time being very easy until Paul Volcker came along. You had 2001 to 2008, and then again from 2009 to 2012, you had easy money by the Fed, increasingly easy money after 2008, QE 1, 2, 3. But now what we have is the logical extension of this, unfortunately, and that is QE infinity, where Jerome Powell, the Federal Reserve Chairman, has said there are no red lines. There is nothing we will not buy. In answer to a question, we are not even thinking about raising rates. And lastly, get this, I don't think we will ever reduce the size of the balance sheet, the Federal Reserve balance sheet. I think we will simply let it shrink in relation to the size of the economy as the economy grows. So we have now reached a completely different level. I mean, QE1, 2, and 3 look almost quaint if you look back at it. This is a totally different level where, frankly, and I'll finish on this, I think the Fed has lost control. The Fed has completely lost control, and the currency is depreciating. So therefore, gold's going up.
Good points, Adrian. There are two pieces of that I'd like to pull out. One for Rick. Next, if you look at, Rick, we're looking at this bull market that we've just started on compared to the previous bull markets in gold. I believe you, like me, believe it will be more like the 2000 and 2011 run. That took the gold price up 7.5 times from the lows to the peak. The bull market in mining stocks, particularly junior mining stocks, did much better than that over that time frame. But that market was driven as much by the demand side and the growth of China as it was from monetary easing. Of course, we did have some monetary easing post the tech wreck, but Greenspan really was just starting the ball rolling there, and we've seen much more by many degrees since then. So there is some fundamental difference. This time around, we won't have that kind of economic growth. Most likely, if we do, it'll be false because of the monetary expansion. Do you think that monetary expansion makes up for that difference? And if so, is it going to make it lesser or greater than that previous run?
I think the anatomy of this bull market will be different, as you pointed out, because of the lack of demand for other commodities, which is to say, I suspect that a precious metals bull rally will precede a general natural resources bull market by a substantial period of time. The 2000 bull market, of course, all hard asset markets ran simultaneously. I think the second difference, and I'll defer to both Peter and Adrian on this, is that I think the fiscal tools available to the government and the central bankers are less potent now. I think they've fired their best ammunition. And I think that they get less economic growth per dollar of counterfeit or per dollar of borrowing, counterfeit being my definition of a correct phrase for quantitative easing. So I think probably the tools that central bankers and governments have are less effective, less potent than they were last time. Whether that will result in more desperate measures is something that we'll have to see. I think the bull market in the gold equities has changed fairly dramatically too. It used to be that gold equities bull markets went from the best of the best, the largest and most liquid companies, all the way down the value chain to the penny dreadfuls. This time, the penny dreadfuls began to rise fairly dramatically within 3 months of the start of the bull market. Now, whether that's due to social media, whether it's due to a different narrative, but I suspect that the market we're in will resemble the 2000 market, but I also think it'll differ in substantial ways. The bifurcation between precious metals and other materials. And also, I think we'll see changes in the leadership in the equities part of the markets.
Good points. Good points. Peter, if you go back to if you went back to 2007 and back then they actually asked you on CNBC still, but if you were on CNBC Fast Money back in 2007, and you said that, well, actually you may have said this, that a decade hence or 13 years hence, the Fed would have added $4 trillion to its balance sheet, would have pushed interest rates to zero. Half of the world's sovereign debt would be at negative nominal rates, not real rates, negative nominal rates. And then the Fed would turn around and add another $3.5 trillion to the balance sheet. And instead of doing it over 5 years, they would do it over 5 weeks. They would have called you crazy. Now, keep in mind, you may have actually said that back then, and they may have actually called you crazy. You may not be the best example for this, but it is absolutely amazing that crazy talk has become normalized. We look at this, and even on CNBC, these very mainstream commentators are talking about Fed balance sheets of $7 trillion and negative rates or zeroed interest rates forever, and they act like this is normal.
Yeah. Well, I mean, first of all, Brien, I mean, when they used to have me on CNBC years ago, I said a lot of things that they said were crazy, and pretty much all of them, or most of them, have come true. But one of the things I said repeatedly from the beginning on CNBC, and of course, you know, at conferences like your conference in New Orleans, from the beginning, I said that QE1 would not work. I said that if they did it, they would have to repeat it. And of course, we had QE2 and we had QE3. And I was saying, you know, the Fed had checked us into a monetary roach motel, that we would have more QEs and Rocky movies, because I understood that each time they did it, they simply weakened the economy and created a bigger bubble that was more dependent on their monetary heroin. And when the Fed finished QE3 and pretended that they would never do it again, and that they were in fact going to normalize interest rates and shrink their balance sheet, I was one of the only people that said, no, we're going to have QE4 and it's going to be bigger than QE1, 2, and 3 combined. And that prediction has already come true. And in fact, it's not because of COVID. COVID is the excuse. This was inevitable. This was going to happen. This gives them a convenient excuse to pretend, well, it's only because of this disease, which we've overreacted to anyway. But the real threat to our economy is not the health threat of COVID, but the government's response, not just in overreacting to the health threat, but in creating an economic and a monetary threat through the increase in government spending, and more particular, Fed money printing, which is enabling the spending by monetizing all of this debt. You now have a situation where the Federal Reserve is providing about 60 cents out of every federal dollar being spent. So the government is funding itself through inflation. And that means, you know, what Adrian referenced earlier, the debasement of this fiat currency, we're going to see the dollar losing purchasing power, you know, at a rate that we've never before experienced. And so more and more people have to start turning to gold. And, you know, people told me, Peter, you know, is it too late to buy gold, right? Gold's, you know, over 1,900, almost 2,000. That's about double what it was at the end of 2015, beginning of 2016. And I have to remind people, you have to forget that it fell sharply to get to 1,050. Gold simply recovered what it lost starting from 2011, when everybody bet wrong. Back in 2011, people believed the Fed. They believed that they could shrink the balance sheet and normalize interest rates. Well, now that everybody should know that that was a lie, they should have listened to me instead of the Fed. All we've done is got back to where we were. Gold has gone sideways for the last 10 years. It hasn't gone up. Meanwhile, we've printed all this money. We're going to print even more money. So I think all we've done is built a beautiful base from which this next leg of the bull market is about to begin. So I think people buying now are kind of still getting in near the ground. It's nowhere near the top.
Preaching to the choir, I think is safe to say, Peter. Adrian, getting back to yet a third point you made that I thought was really good. I thought it was a really good point because it leads off all the presentations that I give now to more mainstream audiences that are new to the sector. And that's that, you know, I lead off by asking them, what's the value of an ounce of gold today? And people yell out various prices in the audience. And then I get the pleasure of telling them they're all wrong, and that the value of an ounce of gold is an ounce of gold. Now, the dollar is about 1,932nd of an ounce of gold. But you brought up this point, great. Gold is the anchor. Gold is the center of the monetary universe. Like Copernicus, when he developed the heliocentric theory of the world, of the solar system revolving around the sun. Once you look at gold at the center of the financial solar system, it changes how you think about things. Currencies do not increase or decrease in value. The dollar index becomes meaningless, essentially, and the dollar and other currencies simply depreciate against gold. So from that standpoint, we look at where can this gold bull market go in terms of other currencies. And the way to look at that then, I guess, is how much lower can currencies go? against gold. And what's your view of that? Are they all racing to the bottom of the hill? And when will they reach the bottom of the hill? What levels will that indicate?
Well, there really is no bottom, of course, because something can decline by 90% after it's already declined by 90%. I mean, you know that, obviously, we all know that. And so what we've seen since the Federal Reserve, I mean, I am an enormous critic of the Federal Reserve, the whole concept of the Federal Reserve, not the individuals. I mean, the last few, like Bernanke and Yellen, were just absolutely useless anyway. I wouldn't hire Bernanke to run my popsicle stand. But the whole concept of the Fed, from 1913, when the Fed was introduced, until today, the Fed has not just presided over, but the Fed has caused the dollar to lose over 99% of its purchasing power. And people think that's normal. They think it's normal for currencies just to decline in value. Well, in 1913, the dollar had precisely the same purchasing power that it had in 1865 at the end of the Civil War. The British pound in 1913, on the eve of the First World War, was actually stronger than it had been in 1815 at the end of the Napoleonic Wars. And during that whole period, that whole century, Britain had a century of mild deflation, which of course is a positive. I'm sorry, I'm ranting now because there's only a little bit of time and I've got to rant. For a central bank to say we want to target inflation is not high enough. Think about it. We want the costs that you pay in the store to go up. We want to depreciate the value of the dollar. That's what the Fed is saying when they say we want to target inflation. This is perverse.
Adrian,
one of the best things that our dear friend Paul Volcker said, and he wasn't a free market Austrian by any means.
Yeah, let me interrupt you, Adrian, for a second.
One of the best things he said just before he passed away was, why doesn't the Fed target stability? Sorry, Peter.
Yeah, the point I want to make, Adrian, you're correct. The dollar lost 99% of its value while the Fed was promising stability. They promised stable prices. So that meant that they were going to try to fight inflation. If we lost so much value back then, can you imagine how much value we're going to lose now when the Fed has actually changed its goal from fighting inflation to creating inflation? And in fact, the Fed is now saying that the inflation we've had in the past isn't high enough, that we need even more. And so they're going to make sure that the cost of living in the future rises even faster than the cost of living in the past. I mean, this is amazing. I can't even believe that we're living in this time.
Yeah, and I'm sitting here trying to get past the image of Adrian operating a popsicle stand in old San Juan, Puerto Rico, which Adrian may actually be a good business venture if you're looking for investors. I can see that actually working pretty well. But you both bring up a great point that I'd like Rick to address here. You know, we talk about the trick box that the Fed is in, how it's painted itself into a corner, progressively lowered interest rates in the course of every economic slowdown since the 1980s till we're just locked at zero, perhaps even going into the basement into negative rates. But it all revolves around this board of experts pulling the levers on the economy and managing the economy. And now they've created this monster with the financial markets. They have to keep feeding the monster. They are stuck where they can never raise rates. For one thing, the debt's grown so large we couldn't afford to service it. We had rates of any significant positive degree. So they're stuck in this trick bag. But what if they lose control? What if the bond vigilantes return and say things are too crazy? Can the Fed lose control? Can they just overwhelm the markets of purchases to keep rates low? What if they lose control and the market demands higher rates?
That's above my pay grade. I'll begin by saying that. The truth is I have no earthly answer. The circumstance that we have now with negative real and in some cases negative nominal interest rates is already above my pay grade. I'm a lender by trade. I'm a credit analyst. And the idea of, as Jim Grant calls it, return-free risk is not something that they taught me in finance in business school. So the Fed has already pulled off a degree of magic that was incomprehensible to me as a lender in 40 years. I mean, I'm impressed with them in one sense. They've been able to maintain confidence. They've been able to maintain public confidence through this whole parade. And actually, for the first time ever, they're sort of telling the truth with regards to the U.S. 10-year Treasury. 60 basis point nominal yield in a currency that they say is depreciating by 1.5% a year. They absolutely positively promise to give you back less money 10 years from now than you gave them today. And people seem to be happy with that. I'm dancing around your question because the whole circumstance that I'm inhabiting today is incomprehensible to me. I don't understand it. The other day when, Buffett was questioned about this, he said something to the effect that negative real interest rates are not a force of nature, they're a construct of man. And I completely agree with that.
I
can't improve on that.
The answer to your question is that the market has been corrupted by the Fed. I think the bond market vigilantes have been neutered by the Fed. The real buyers are central banks, mainly the Fed, and speculators. I don't think any legitimate investor is willing to loan the U.S. government money for 10 years at a negative rate of return. That's not who's buying. But since the bond market vigilantes really can't do anything because the Fed just keeps printing money to buy bonds, and so you don't have a real market anymore, you have a manipulated market, where you're going to see the discipline and where the Fed is going to lose control is in the foreign exchange market and in the precious metals market. That's where the vigilantes are going to show up. They're going to start dumping dollars and buying gold. And as more and more people want to get rid of dollars, and of course, getting rid of dollars means getting rid of any debt instrument that is denominated in the US dollar. So not just US treasuries, but corporate bonds, muni bonds, mortgage bonds, because all bonds is a promise to deliver you dollars at some point in the future. And if the dollar is losing value now, then the one thing that's worth less than having a dollar today is having a dollar in the future. So as everybody tries to sell bonds because they want to get rid of dollars and they buy gold, the Fed is the only buyer, right? They're not just a buyer of last resort. They are the buyer of only resort. And the only way they can buy is by printing more money. And so it accelerates the cycle of destroying the dollar and the exodus out of dollar-denominated debt.
Adrian, I'm going to give you another chance for another rant, probably on the same subject, but drilling down a little bit to even what's happened today. We saw the stock market have a sell-off that it hasn't experienced for an awful long time, probably a couple of weeks or even more, and which is, an eternity in today's markets. But then the Fed trotted out Charles Evans to assure the markets that the Fed was ready and eager and would probably soon renew its quantitative easing efforts, essentially whatever it took to keep markets elevated, partially because Congress was deadlocked and wasn't able to come through with more fiscal stimulus that was needed for the markets. So there's the Fed put again coming in to support the markets. I guess what I'm getting at here is how long can this game be played where the markets throw a hissy fit because they've been so dependent on this easy money? And what are the implications for the precious metals if we do have some kind of a major crash, the Fed becomes ineffective when we have these kinds of liquidity crises?
Yeah, no, absolutely. What you're saying is absolutely true. But what's really astonishing when you think about it is we had what was it, 800 points today? Mm-hmm. In percentage terms, not a heck of a lot. And it was a one-day decline. And the Fed feels they have to come out and reassure the market. I mean, at the end of 2018, they waited a few weeks before they came out and said, "Oh, don't worry, we're not going to raise rates anymore. Everything's fine." I mean, for the Fed, first of all, the Fed shouldn't be concerned with what the stock market's doing anyway. That's not its concern. I mean, the whole world is upside down, Brian. The Fed should not be concerned with what's happening to the stock market at all. But if it's going to be concerned with the market, at least let's get a normal correction before we all start coming out saying, you know, we've got a toolbox with lots of tools in our toolbox that we haven't used yet and all that kind of trite nonsense. So, yeah, no, I mean, clearly, the Fed put, which is Alan Greenspan's fault in the first place, is alive and well, and they're going to keep on doing this, and it works. And the reason it works, Brien, is quite simple. The Fed is creating excess liquidity. By definition, that is more liquidity than the economy at that point in time needs, by definition. So if the Fed is creating excess liquidity, that liquidity has to go somewhere. That's the reason the stock market has been going up, even in the face of an economic catastrophe, because the money has to go somewhere. It can, in the 70s, it went into consumer prices, and we haven't really seen that very much, but it has to go somewhere. And so it works for that reason. It'll work so long as they keep on printing excess liquidity. But of course, gold goes up in the face of excess liquidity for fundamental reasons, right? I mean, gold is going up because excess liquidity, by definition, again, is destroying the purchasing power of the dollar, therefore supporting the purchasing power of gold.
Rick, we are all seemingly agreeing right now on a very powerful argument for much higher gold and silver prices over the long term. Perhaps one of, if not the strongest, most powerful and wealth creating bull market in the metals, and a scenario that would be more destructive to wealth if you're not involved in the metals than ever seen before. So I'm going to flip the tables on you and take a piece of your own advice that you give people when they're talking to, say, junior mining company executives, and you hear this grand, well thought out argument, and ask them, and I'm asking you, what could go wrong? What could go wrong with the argument we're presenting here today? What are we possibly not considering that would lead to lower gold and silver prices?
Well, given that we all said the same thing in the year 2000, I guess we could be 20 years too early again. And confidence in the system could be maintained. With regards to gold, to be honest with you, with regards to the metal, I have a difficult time seeing us be wrong, but obviously I'm conflicted. With regards to the junior gold shares, though, Brien, I can give you an answer to that. I think everyone on the panel would agree that the free market, private companies, are always better than the government in every respect. And in the last 6 weeks, the Canadian dealer network has printed more phony share certificates and more junior mining financings than the Fed has printed dollars. The amount of counterfeiting that's going on in equities markets rivals anything that the Fed could do. And the truth is that the dealer network, particularly the Canadian dealer network, has the ability to create phony share certificates fast enough to swamp any demand. That's another example of excess liquidity. Companies that enjoyed, if that's the right phrase, $5 million market caps 6 or 7 months ago, of course, credit the fact that the gold price went up for the increase in their fortunes. The problem with that credit is that these companies have no gold. They're looking for gold.
Wow.
And if the price of something that you have none of rises, it shouldn't make any fundamental difference.
Yeah.
But the truth is, we've seen circumstances where companies that had 5 million market caps now are raising $45 million with $75 million pre-money valuations. It's as though the Fed lent some of its expertise to the Toronto and Vancouver paper mills. And so if you want to know what could go wrong there, it's that many people speculate as stupidly as they vote.
So excess.
That's my rant.
We're going from rant to rant to rant. And Peter, I will not be
so far.
Yeah, that's what we do. We all must do what we do best. Speaking of which, Peter, I guess I'm too timid to ask you to say where could we be wrong, but I will ask you, I will harken back to a conversation or discussion you and I have had a few times over the years. The last collapse in the global financial system that you predicted did not actually end up in the collapse of the dollar, but you predict this one will be the big one that ends up basically destroying any remaining shred of credibility in the dollar.
Yeah, I mean, Brien, the only thing I got wrong in my forecast of the 2008 financial crisis was the aftermath and how long it would take for the Fed's cure to kill the dollar. I mean, I got everything right about the housing bubble and how it would collapse, and I understood, what inflated it and what was going to transpire, after the bubble burst, and what would happen to housing and banks and Fannie and Freddie. And I got the government's response 100% right with the QE and the slashing interest rates. But at the time, I thought that the markets would be smart enough to realize where we were headed. And for a while, it looked like I was right when gold hit 1900 in 2011. It looked like my original assessment back in 2003, 4, 5, when I wrote my first book was correct. But then the Fed managed to convince the world that it could do the impossible, that it could, in fact, take us off that monetary heroin, that it could get us out of that Roach Motel, that it could normalize rates, it could shrink its balance sheet. The Fed was bluffing, they were completely wrong, but the markets bought it. And so we were able to kick the can down the road for a decade. See, I thought the Fed would try to reflate the bubbles in the stock market and the housing market, but that it would fail because the dollar would crack. Instead, they succeeded where I thought they would fail. They actually blew up an even bigger bubble than the one that popped in 08. And now they made the crisis so much worse. So now we're going to get the dollar crash that I predicted back then, only much worse, because the problems are so much bigger now than they were then. And even though I underestimated our can kicking abilities back then, I think it's impossible now. This can is way too heavy. You kick it, you break your foot. So I'm not even concerned that at this point there's any way that my ultimate, outlook isn't going to be correct. And I wanted to make one point with what Adrian said about the Fed and why the Fed is so concerned about a small drop in the stock market. Look, the Fed knows they're basically targeting the S&P. They might as well come out with an S&P target in addition to an inflation target. All of their stimulus is geared to a phony wealth effect. They want to keep asset prices propped up because that's all they can do. Their stimulus is actually sedating the real economy. All they've got going is the mirage of phony wealth, and they have to keep it going at all costs.
Which, of course, is exaggerating the wealth gap in the United States. The Federal Reserve and its policies is
and these fools in Congress want to put the Fed in charge of closing the gap. They're saying they want the Fed to try to reduce the very gap that it's exacerbating with its inflationary policies.
Absolutely.
And inflation, of course, is the big inequalizer, that the last tool that they want to bring to bear, and it is the ultimate inequalizer of wealth. Now, okay, we're getting toward the end of our allotted time, probably a little bit over already, but that's okay. Let's assume that our audience includes a number of people who are new to the sector, who buy our arguments and want to get involved in gold and silver. And Adrian, let's start off with you. What would your advice, outside of telling them to go to goldnewsletter.com and downloading my investor's guide to gold and silver?
Oh, I hadn't thought of that.
For free. I don't know why you didn't think of that. Outside of that, what advice would you give an investor to participate in this sector?
Well, obviously, Peter Schiff has an excellent gold fund that we happen to manage, so I would certainly recommend that. I think for people that are, I'll say two things. People that are new to this sector, a couple of things. One is recognize, if you don't know it, recognize that gold stocks are inherently volatile. They're very volatile on a short-term basis and a long-term basis. And if you're investing in individual securities, or indeed in a fund, you have to recognize and be prepared for that volatility. A lot of people who have switched from bonds, the 40, 60 stocks bonds over into gold, may not be prepared for the kind of volatility that's inherent in this sector. So that's number one. The second thing I'll say though is this, and I don't know if Rick, for example, would agree, but you know, Rick talked earlier about how normally, you know, typically the seniors move first, and then the intermediate and junior producers, and then it's subsequent, it's later, but the juniors and exploration companies start moving. What is unusual, what is really unusual about where we are right now is we've had a very strong gold market. The outlook for gold is remarkably strong, and yet the senior gold stocks, and I'm not saying they're all good quality companies, we're not, you know, we don't have time for that discussion, but the senior gold stocks, which are the more certain stocks to move in a gold bull market, right? They're more certain to move, are still amazingly undervalued. And let's just look at Barrick, for example, because Barrick's number one, because Warren Buffett just decided to invest in Barrick, not necessarily it's my main pick or anything else. But if you look at Barrick, you see a stock price, you see gold at all-time highs, you see Barrick today, much better management than in 2011, Barrick today, a stronger pipeline than in 2011, Barrick today, a better balance sheet than in 2011, and no hedges. And yet the stock price is half what it was in 2011. There is an enormous valuation gap today between where the gold stocks with better discipline, better managements, a valuation gap between where they are and where they should be. And so for the person that's new to the sector, the words I will close with, I don't think you've missed this market by any means. And you are in a very, very, very fortunate position. If for whatever reason that I cannot conceive of, you don't want to invest in Peter Schiff's mutual fund, you can still buy the best, you can buy individual mining companies, you can buy the biggest and the best, and still be buying undervalued gold mining.
Don't try to talk anybody out of buying our fund, Adrian.
Oh, sorry.
what Rick said was right too. You got to avoid the landmines when you're trying to buy the gold mines. That's why I was smart enough to hire Adrian to manage our fund, the Euro Pacific Gold Fund, which people can pretty much buy anywhere. But I wanted to make a point about this valuation gap, because to me, what this says is that investors don't believe the bull market. It is climbing a wall of worry. Nobody believes the high gold price is here to stay, because they're not willing to bid up the price of gold miners, because what gold miners reflect is investor expectations for the price of gold in the future, not the price of gold in the present, because they're trying to bet on the value of future earnings. And so to me, the major money on Wall Street is betting that the price of gold is going to go down, and that they've already discounted a falling gold price into these gold stocks. And so when they're proven wrong, not only do you get to make all the gains for the gold stocks for gold going up, but you get all the gains for the price of the gold just staying where it is. Because even if gold stays where it is, the gold stocks have a long way to go, but it's not going to stay where it is. It's going much higher.
I agree with what you say, Peter. I think the gold producers, the seniors, simply have not been able to keep up with gold's last rally and are relatively undervalued right now. So Rick, I will leave it up to you to close this out here. This is your opportunity to give some good, valuable, practical advice to our viewers, and also a shameless plug in for yourself. So take it away.
I would say that in addition to the fine Schiff fund managed by Adrian Day, Sprott has a range of precious metals related products, including a couple of equities funds. Now that I've had the opportunity to get that plug in, I'll answer the question. One thing that I think that we didn't talk about today that's become very apparent to me is that as much as we care about gold, as an asset class, it's an asset class that, despite the fact that it only has 4 letters, Wall Street can't spell. I very frequently talk to financial advisors in the course of marketing Sprott's financial products, and generalist audiences as often as they'll have me. And I'll lay out the whole sort of gold thing in detail. And a financial advisor, good salesperson, well-versed in Wall Street will say, that's a really interesting idea. I never thought of it. About a year and a half ago, I read a study, and I believe it was from JP Morgan Chase, that said that precious metals and precious metals related assets constitutes between 1/3 and 1/2 of 1% of savings and investment assets in the United States. The 3-decade mean was between 1.5% and 2%. So if the circumstances that we've talked about today with regards to the depredation of the purchasing power of the US dollar cause some people to come into gold, they're coming into gold from what was already, as Peter described, a very oversold position. Gold doesn't have to prevail against the US dollar. It just has to lose less badly. If we merely returned gold to the market share relative to other asset classes that it's enjoyed, the mean market share that it's enjoyed over the last 30 years, demand for precious metals and precious metals related assets in the largest savings and investment market in the world would triple or quadruple. I don't think that's asking too much personally.
Great way to end it, Rick. I think that's another important point. And I think this wraps up the conference very well. We've looked in this panel at some of the big picture macro issues that are pointing toward the biggest bull market, perhaps, that we've ever seen. And I think the lesson here is to be informed about this sector, be prudent in your investments, watch the cycles, but be involved. It's necessary not just for wealth creation, but wealth preservation in the days ahead. Gentlemen, thank you so much. A better panel I could not have imagined. A lot of fun here. Thank you so much.
Yeah, thanks for hosting this. And I'll give you a plug too, Brien. We'll see you at your virtual New Orleans conference that is coming up right in November.
October 14th to 17th.
Okay. Sooner the better.
Peter. I owe you one there. Thank you. Thank you for that. And all of you gentlemen will be there as well. So I really appreciate it.
Thanks all.
Thank you. Thank you, everyone.
Gentlemen, fantastic presentation tonight.